Hi everyone, welcome back and thank you for supporting the channel. If you're new here, I'm PPE and this is the Peso Pro episodes where we talk about personal finance and money management tips and tricks. So if you're here for more videos or information of that, please make sure to hit the subscribe button and the notification bell so that you're updated when the next videos are uploaded. Today, we're gonna talk about a topic that's very sensitive, especially in families or couples or even the regular worker who's trying to make ends meet and managing through their own personal journey, which is debt or utang. In most cases, this topic is very taboo, it's not being talked about, and hence most of us, when we find ourselves in a position of debt, we don't know how to manage to get ourselves out of this hole of trying to manage the debt but not being able to do so properly and end up having more debt than where we were initially when we started off that path. We're gonna talk about two proven methods on how you're gonna combat debt and end the cycle of utang, tapos babayad ng utang, utang ulit, or even worse, nangutang sa iba para pambayad ng utang mo sa ibang tao din. Right? This endless cycle of trying to live within debt has been a plague for most Filipinos of almost all social classes. And I think a conversation about this and trying to figure out why we struggle on how to manage is gonna be very helpful, especially as we enter the new year. Hopefully, a renewed passion to make our lives a bit better, especially from a financial standpoint, but also, more importantly, from a psychological standpoint. When we talk about debt, we're actually talking about something more than money. Imagine the times when you had debt lingering over you and you know that someone, either a person you know, a relative you borrowed money from, or even a bank or an institution would come knocking down on you, calling you on your phone, sending you demand letters. That's not a good place to be in. And I don't think anyone wants to be in that place forever. All of us, whether we wanted to be in debt or got forced into debt, do not want to stay in debt. So, how are we gonna manage our finances regardless if you earn 6-digit salaries or if you earn the minimum wage? How do you manage those financials and try to do your part to get out of this debt cycle that people sometimes get trapped in for years and years? There are two proven ways of how to manage debt, and you probably heard about this before. In this video, we're gonna cover those two, and I'm gonna end with a bit of a personal advice that may help you as you embark on this journey. When we talk about debt in this video, I'm talking about almost all debt except for a housing loan or a mortgage. The reason for that is while all debt for me is bad and something you want to get out of, some debts are slightly less bad than others. There are debts where you take to actually create assets or build your portfolio. In the case of a housing loan, that's exactly what you do. You take on housing loan because you typically would shell out millions to buy a property, but you hope over time that the value of that property appraises in the coming years, so you make up the interest payments that you made for the value that you actually got from the real estate property that you bought. We're gonna talk about housing loans in the near future. There's one place I think where there's tremendous value, but for now, we're gonna take that off the table and we're gonna focus on consumer debt. When we say consumer debt, ito yung mga normal utang that you do. So typically, it can be your sanla or pawn shop kinds of lending where you borrow at a rate of about 3 to 6% per month on average, and you give something of value. Typically, it's jewelry or something techy like a phone or a device of value so that they can guarantee your loan with that item. It can also be borrowing from friends or even borrowing from banks via a personal loan or sometimes in your company cooperative. We're also gonna talk about credit card debt as one of the examples, but we're gonna focus on credit card debt in a future video because that one takes a bit more time to understand and there are many intricacies that we can still unravel so that you know how to manage credit card debt specifically. Okay, with all of the preamble out of the way, When we talk about consumer debt, typically the average person will somehow in their lifetime have about 1 to 4 consumer debts at the same time. When we talk about consumer debts, you probably will have like a personal loan or an outstanding balance in your credit card, or you borrowed money from your parents or a friend. So on average, you have somewhere around 1 to 4 debts at a given point in time. All of those debts have varying interest rates that the bank or the person you're lending to or the institution that you borrowed from is gonna charge you. In some cases, especially if you do informal lending, it can be as high as like 10 to 12% per month, and that's gonna be eating away the value that you earn every month, and it's gonna compound very, very quickly. So how do you take advantage of these two processes or approaches into managing debt? So first, let's go into the first example that I personally like, but I also recognize that the other example may be applicable for more people. Let's talk about the debt avalanche method. As the word suggests, the debt avalanche method, so avalanche, landslide kind of approach, takes into account that when you look at, for example, if you have 4 concurrent debts today, you look at the interest rates of all 4 debts, and in Excel speak, you sort descending, or you sort from the one with the highest interest rate to the lowest interest rate. The most common ones with the highest interest rates are informal lenders or loan sharks, or what we affectionately call as 5-6. Right? They're typically charging us anywhere between 10 to 20% per month, and they can be the ones that are very, very hard to pay off because as soon as you make a partial payment, the interest rate hits you immediately. The lowest ones can be the formal types of loans that you get from banks, like personal loans, and you can sometimes get this at an average of 6 to 11% depending on your credit history and your relationship with the bank. So in the debt avalanche method, what you do is you pay all the minimum amounts that are due on each debt. So meaning, it's not that we are gonna forget all of the other debts. We're gonna pay all of the minimum amounts in the 4 debts. Let's say we have an extra 1,000 pesos after paying all the minimums on all debt. The debt avalanche method basically tells us that what you do with that 1,000 pesos extra, or any money that you can generate in excess, you put to the loan with the highest interest rate first. So in our example, if you have a loan shark or a 5-6 lending, if that's the highest interest rate loan, what you're gonna do every time you get extra money, every time you're able to save beyond what you typically save, every time you say you do a side hustle or you have like a mini business that earned you a bit more for the month, you throw all of that money into the highest interest rate debt. What this would do is it would create an avalanche approach, which means after you're done finishing the one with the highest interest rate, you put all of that money, including the minimum amount that you paid on the first loan, onto the second loan, which becomes then a bit easier because by now you've already developed the habit of paying big amounts on the first loan. What this will do visually is it will create a landslide approach on all of your remaining debts, and ideally, if you continue the pace of what you're paying and you just pay religiously, you're gonna finish off the loan with the least interest expense possible because you paid off the ones with the highest interest rates first. This is probably the most efficient method to pay debt because essentially, if you take time paying, as long as you have lower interest rate debts at the end, you're gonna save on the interest costs that you will end up paying for. The second method that we're gonna talk about is the debt snowball method. The debt snowball method, if you now have this winter analogy in your mind, the debt snowball is the other way around. So think about those same 4 loans. What we're gonna do is we're gonna sort them not using the interest rates, we're gonna sort them using the amount on the loan. What this does is you take the smallest loan. For example, let's say you have a balance in your credit card of say 10,000, and then you have a G credit balance of say 5,000 pesos. You would put the 5,000 pesos G credit at the top of the list because it's the smallest amount of debt. where even if it doesn't necessarily have the lowest interest rate. In this method, you're not going for the most efficient way to pay off debt and saving the most interest. But what this does, and actually finance gurus like Dave Ramsey or even other finance professionals and psychologists recommend the debt snowball approach for most people who have difficulty managing multiple debts and are not sure where to start. The good thing about the debt snowball is if you have the snowball as an example analogy in your mind, this snowball starts to be a tiny snowball at the beginning. You still pay off all the minimum amounts in all your debts, and let's say you still have that extra 1,000 that you have. What you would do is, instead of just paying the bare minimum on all debts, what you would do with that extra 1,000 is pay off the smallest debt in your list. What this would do is it will cut the time for you to pay off one debt, even if it doesn't make the highest interest rate, even if it's not the most significant debt. That feeling of accomplishment and positive affirmation in your psyche will help build that momentum so that eventually your snowball becomes a bit bigger and you accumulate all of the payments that you were paying on the small debt and put that into the next smallest, then to the next, until you finish all of your debts. The good thing about the debt snowball method is it gives you this sense of feeling that you were able to accomplish a goal regardless of how small it is, whether it's not the highest interest debt. As long as you feel that satisfaction within your psychology or your emotions, that's likely going to propel you to actually stay the course so that you eventually build a bigger and bigger snowball, because now the payments that you were paying for the original debt can be used to pay the next debt, which becomes a bigger snowball, and then eventually you create a big enough snowball that will pay for all of your debts. The Avalanche method is the most efficient way, but a lot of people fail to complete their entire list of debts to pay off because sometimes the debt avalanche will also direct you to actually pay for the hardest loan first. Because if that's the one with the highest interest rate, sometimes that's also the same debt with the highest balance that you have to figure out. Now that you know about these two strategies, it's entirely up to you to craft your plan on how you're going to repay your debts. But one last question before we end this video that I get most often is the question of, if people are telling me to save and invest, should I do that first before paying off my debts, or how do I manage the balance between the two? After all, we all have limited amounts of money, which is why we're in debt in the first place. The short answer is actually not so short, because the answer is it really depends on your personal situation. However, there are maybe two rules that you can probably start with and start really thinking through based on these two principles or rules. Number one, I have seen a majority of all the investment ideas that are relatively safe and are averaging at the market rate of returns. In these cases, most of these investments return an average of 4 to 8% over the long term. Now, if they return 4 to 8% over the long term, typically most consumer debt will be more expensive than that. Just take into account, for example, even a personal loan from a reputable bank would probably be in the 8 to 12% range if you are a regular customer. If you're a VIP customer of like having multiple years with that bank, you can probably lower that to 6% on a good year. But even then, the difference between debt and investing is almost always that debt would have higher interest rates. And remember, debt, similar to investing, also compounds. So, in that rule number one, just consider the interest rate for the debts that you have. However, in most cases that I have seen, it's typically that debt is higher interest rate versus the reasonable returns that you can get from investing. The second rule is much less about money and dollars or pesos. It's a lot to do with just your personal behavior around money. Typically, one of the lowest points in a personal finance discussion is when you talk about debt. especially the debt that's born because of necessity and not by some investment choice, or in a business or in a real estate property, for example. In most cases, if we talk to people about debt, the general consensus is that it's negative, it tends to be something that they think about, some even can't sleep properly at night. And so even if you argue with me that there may be investments that will return higher than the interest rate on your debt, sometimes the extra 2 or 3% that you get from those investments will not warrant you maintaining that debt for longer periods of time, because that will always be a shadow above your head that you will always think about. When will this person chase me for the money that I owe him or her? Or when will this institution start sending demand letters if I don't pay on time? Now, I'm not saying you chase down debt 100%. Savings for your emergency fund, rather, is still very important. And that's why if you go back to the 8 pro steps towards financial freedom, and we'll link to that in the description box below or somewhere in this video, go ahead and check that video, because you will notice that while we advocate for paying off debt, especially high interest debt, the first few steps will really help you set up your savings habit and an emergency fund so that it will create a solid foundation for your financial journey. However, I'd like to end with a note that the reason why this is number 3 in our pro steps is just because of both the financial and the emotional baggage that debt carries, and it can have the long-lasting, irreparable damages to some of your closest relationships if you don't take that into account earlier on. That's it. I hope this video was helpful to you. In future episodes, we'll talk about specific kinds of debt like credit card debt or even mortgages or housing loans, and how you're able to manage that. So please hit the subscribe button. That it helps the channel a lot. Click on the notification bell so that we will be able to send you updates. You'll get notified once we upload new videos. And hit the like button below if this was of any value. Please share with a friend, and stay tuned and watch our other videos to see if you have other topics that you may be interested with, or comment in the comment section below so that we can take a look, and it would give us ideas on what videos we can come up with next time. Thanks, and I'll see you again soon.